All right. The closing bell rang about 15 minutes ago. And if you're just, glancing at the headline numbers on your phone, you might think today was a quiet walk in the park. It wasn't. Let's hit the scoreboard. The S&P 500, it edged up just barely, closing plus 0.12%. The Nasdaq actually clipped a minor loss, down 0.05. The Dow was the leader, gaining 0.28%. But the price action does not match those numbers at all.
Calm is definitely not the word I would use, not for the last 6.5 hours anyway. This was a choppy mess.
Horrible mess.
We saw absolutely zero follow-through on that attempted breakout this morning. If you were chasing momentum today, you got chopped up.
For sure.
The market is it's paralyzed. We are sitting in this neutral holding pattern, and honestly, everyone is terrified to commit any real capital before the macro data drops tomorrow, and we have to talk about the elephant in the room. The 10-year yield.
It's creeping up again.
It's more than creeping. It's sitting at 4.27% right now, and it's inching towards that 4.5% danger zone. That yield is acting as a concrete ceiling on growth stocks.
Right.
Every single time the Nasdaq tried to breathe today, the bond market just choked it out. It's simple math, If you can get a risk-free return approaching 4.5%, the hurdle for owning a volatile tech stock just gets higher and higher.
So a flat close on the index, but just a ton of noise underneath. Let's unpack the narrative. Why did we see that weird price action? We opened high, flushed completely red midday, and then just surged back in the last 90 minutes. What was the catalyst for that?
It's being called the Greenland Pivot.
Of course it is.
Yeah.
That sounds like something out of a Cold War thriller.
It really does. But we have to look at Davos. President Trump's speech there basically de-escalated the whole acquisition by force rhetoric around Greenland.
Okay, I see.
The market was pricing in a geopolitical nightmare scenario yesterday, that huge Sell America rout we saw on Tuesday. That was all driven by fear of immediate conflict. So when the rhetoric softened today, we got a relief rally.
So that's what drove that V-shape.
That's it. That recovery of about 0.6% from the lows, it clawed the S&P right back toward that 6,830 pivot level.
Okay, so the narrative is geopolitical risk off, buy stocks. The algorithms read the headlines, saw the word negotiation instead of acquisition, and they just bought the futures. But here is where it gets really interesting and where I have to throw some cold water on this whole party. I'm looking at the volume data.
Light.
Light is an understatement. It was a volume lie. Total volume today was roughly 12% below the 30-day mean. This was not a high-conviction institutional reversal. When you see a rally like we saw in that final hour, that V-shaped recovery, but the volume is just gone, that's a vacuum rally.
Meaning there were no sellers left, not that aggressive buyers were stepping in.
Exactly. Imagine a room where everyone just stops talking at once.
Yeah.
It's not that someone started shouting support. It's just that the critics left the building.
Right.
The big money, the pension funds, the sovereign wealth, they sat on their hands today.
Right.
What we saw was retail and fast money algos covering shorts because of the Greenland news. It wasn't a change in trend. It was an exit strategy for the bears. My verdict. Conviction remains incredibly low until we see a high volume close above 6,900 on the SPX. Until then, this whole thing is suspect.
And that aligns with the geopolitical context, too. I mean, yes, we got the Greenland pivot, and yes, the framework deal with NATO on the Arctic gave trading desks a reason to stop the bleeding, but I want to warn you, do not mistake a sigh of relief for a real change in trend.
Good point.
We are still in a headline regime, one tweet, one statement, and that relief rally just evaporates. The fundamental issues, the tariff structures, the debt ceiling talks looming, none of that was solved by a speech in Switzerland.
And if you peel back the curtain and look at the internals, this illusion of strength becomes even more obvious. Let's look at breadth. The S&P was green, right?
Yeah, barely.
But the advanced decline ratio closed at 0.8 to 1. There were more losers than winners today.
That's the heavyweight lift.
Precisely. Just five mega-cap AI infrastructure names accounted for 82% of the day's gains. 82%. If you didn't own those 5 names, you probably had a red day.
Yeah.
It just masks the rot underneath.
And that's a divergence that concerns me deeply. I mean, we saw price make a marginal new high intraday, but the cumulative advanced decline line, it failed to confirm it. That line peaked 3 sessions ago.
Right.
When price goes up and participation goes down, that is usually a sign that the breakout has no fuel. It's running on fumes. It's like an army where the generals are charging up the hill, but all the soldiers have turned around and gone home. Eventually, those generals get surrounded.
However, there is one area that is not running on fumes, and this is fascinating.
Yeah.
The great rotation trade.
Small caps.
the Russell 2000. It outperformed for a record 13th straight session.
That is massive. We've been talking about this rotation for weeks as a theory, but 13 days of outperformance. That suggests this is a new regime. Investors are actively pulling money out of the Mag 7 and pushing it into domestic, smaller companies.
Why now, though? Is it just valuation?
It's valuation, sure, but it's mostly about policy expectation. If the administration pushes for America first, for tariffs, for domestic production, well, who benefits?
The smaller domestic guys.
Exactly. The manufacturers and service providers, they don't have that exposure to global supply chains that an Apple or a Nike does. They're insulated. So you're seeing a flight to domestic safety, which historically is very rare for small caps. They're usually the risky trade. Right now, they're the safe haven.
And that makes a lot of sense. And look at the sector split today. Energy was the leader, up 1.4%.
Supply side jitters.
Right, keeping a floor under crude. But the laggard. Consumer discretionary, down 1.1%.
And that connects directly to the post-holiday earnings we're seeing. They're showing a thinning consumer wallet. The whole consumer is resilient narrative is taking a big hit.
It really is.
So when you see energy leading, which is a cost input, and consumer discretionary lagging, which is where we spend our extra cash, that's a defensive posture. It's stagflationary positioning, not growth positioning. The market is saying things are getting more expensive and people have less money to spend.
Which brings me to the VIX. The fear gauge, it dropped 4% today, down to 13.2, and on the surface, that looks like complacency. All is well, buy the dip. But here's the trap.
The 30-day implied volatility?
Yes. While the VIX index dropped, the 30-day fear of eye on individual tech names, it actually rose.
That is a classic divergence.
It's a volatility crush at the index level. We're seeing so much selling of zero DTE, zero data expiration options, that it's pinning the index and suppressing the VIX. It's totally artificial.
Let's break that down for a second because it's crucial. When everyone sells these short-term options on the index, the market makers, they have to take the other side. They hedge in a way that just dampens volatility. It's like a wet blanket on the S&P 500.
Right.
But if you look at the individual components at Nvidia, Broadcom, Microsoft, traders are buying protection. They're terrified.
Exactly. It's masking tail risk hedging in semiconductors, which is sitting at a 6-month high. The market makers are hedging for a crash in chips, while the VIX is telling you everything is sunny.
It's the coiled spring metaphor. The surface of the water is calm because of this mechanical pinning, but the undercurrents are just ripping. If that spring uncoils, the VIX isn't going to drift up. It's going to gap up. We could wake up one morning and see the VIX at 18 or 20 in a heartbeat if that option suppression breaks.
Let's dive into some specific tickers, because there were some serious moves today and some serious non-moves. We have to start with the king, Nvidia, NVDA.
It held the line.
Barely. It opened weak, filled the gap, and then reversed to close near 183. It is effectively holding up the entire AI complex right now.
Yeah.
But looking at that weekly chart, there's a head and shoulders pattern looming. If 183 fails...
If 183 fails, the entire structure of the market changes. Nvidia is the general. If the general falls, the morale of the whole market just collapses.
Yeah.
183 is the neckline. Below that, you're looking at a technical measured move that could take us down to the 160s and fast.
Wow.
That would drag the S&P and the Nasdaq down with it, regardless of what other sectors are doing.
Okay, but let's talk about the disaster of the day. Netflix.
NFLX down 5.2%, the day's big loser.
It tried to bounce midday, tried to ride that market recovery and just got absolutely hammered into the close.
It's all about the guidance on the Warner Bros. Discovery integration. It's spooking the empire builder thesis. For a long time, the bull case for Netflix was clean. Streaming dominance, high margins, recurring revenue.
Simple story.
Very simple. Now, with the WBD integration, investors are looking at the debt load, the execution risk, the messy merger dynamics. They're saying, this isn't the clean tech story we bought. This is a messy media conglomerate story. And they are repricing that risk.
And there's another sector taking a hit from headlines today. Housing and REITs, specifically the single-family rental operators.
This is the executive order news.
Right. Trump's executive order targeting large institutional investors in single-family rentals. We're talking about companies like Invitation Homes, INVH, and American Homes 4 Rent, AMH. This is a direct headwind for that whole Wall Street landlord trade.
It changes the math completely. The whole premise of these companies was that they could use cheap capital to buy up neighborhoods, optimize rents, and effectively corner the market. If the administration makes it legally difficult or punitively expensive for institutions to own single-family homes, the premium on those stocks has to come out.
And that's happening now.
You're seeing that risk priced in today. It's regulatory risk that just wasn't there 48 hours ago.
Okay, shifting gears to the institutional footprint. We talked about low volume, but we did get a market on close, an MOC imbalance.
We did. Skewed $1.8 billion to the buy side.
So someone was buying.
Yes, but you have to interpret what they were buying. They weren't chasing the macro rally. They were protecting levels. They bought the dip in semis. Micron was up 8%, Nvidia up 3.1%. But notice what they sold. They actively faded consumer platforms like Netflix. They are buying the infrastructure of the future, the chips, and selling the consumer of the present. That tells you where smart money thinks the economy is headed. They're betting on the build-out, not the checkout line.
Okay, so we've got a very mixed bag closing out Wednesday, but Thursday. Thursday morning is main event. What are we looking for?
It's all about 8:30 a.m. initial jobless claims.
The soft landing narrative.
It hangs in the balance. If claims spike above 225K, the soft landing narrative isn't just threatened, it is broken. The market is hypersensitive to labor data right now. We've been in this Goldilocks zone where the labor market is cooling but not freezing.
Right.
If we pop above 225, that signals freezing. You combine that with the consumer weakness we saw in the discretionary sector today, and recession fears come roaring back.
And from a technical standpoint, where's the line in the sand for the S&P?
It's the gamma wall at 6,800.
Explain that for our listeners. I know we throw around gamma a lot, but why is 6,800 specifically the magic number here?
So think of the dealers, the banks facilitating trades, as having to constantly balance their books. Above 6,800, their positioning is long gamma. This means when the market drops, they buy to hedge. When the market goes up, they sell. They act as a stabilizer.
Like shock absorbers on a car.
Exactly. They dampen the volatility. But below 6,800, they flip to short gamma. The math totally reverses. If the market drops, they are forced to sell more to stay hedged. If it drops further, they sell even more.
They stop being shock absorbers and start being accelerants.
Precisely. That's why we say if we lose 6,800 on a closing basis, do not try to be a hero. The dealers will be selling into the hole, and we could see a liquidation move straight down to 6,710 very, very quickly.
And looking at the probabilities, Wednesday was an inside day. We didn't break Tuesday's high or Tuesday's low. Historically, what does that signal for Thursday?
An inside day usually represents a pause, not a reversal. It's the market taking a breath before continuing the primary trend. Since the primary trend this week has been down, that Tuesday's sell-off, the probability of testing Tuesday's low of 6,796 remains high. I'd say about 60%. Because we didn't reclaim 6,900, the bearish structure is still intact. This was just a breather.
So with that in mind, let's talk actionable ideas. Day 2 plays. What's on your radar?
I'm looking at the bear case for Netflix. We call this the day 2 follow-through.
The momentum continues.
Exactly. When a stock breaks on high volume like Netflix did today, down over 5%, institutions often spend the next day rebalancing and exiting positions they couldn't get out of on day 1. If NFLX breaks Wednesday's low, expect a flush toward that $580 support zone. That's a high probability short setup.
And on the flip side, anything bullish worth a look?
The bull case is wise. Jumped 16% on earnings and guidance. Strong day 1 closers with high volume. They typically see continuation in the first 90 minutes of the next session. Traders who miss the move will try to hop on tomorrow. I'd be watching for a break of the high of day at the open for a quick scalp. But be nimble with it. Don't marry it.
All right, let's wrap this up. The final trade. The one thing our listeners should be watching at the open.
The asymmetric trade here is to fade the gap.
Walk us through the setup.
We know there's optimism from the Davos speech. The European session might bid things up overnight. If the S&P 500 gaps up tomorrow morning into that 6,880 to 6,900 zone, you short it.
Short the strength.
Yes, short the move. Keep your stop loss tight at 6,915. Your target is a return trip to 6,800.
And the thesis.
The thesis is that the structural damage from Tuesday's tariff news isn't fixed by one speech in Switzerland. The market is over-exuberant about the peace talk, but the math doesn't support a V-shaped recovery yet. The volume wasn't there. The internals aren't there. So if we pop, it is likely a trap. The risk-reward on fading that gap is like 1 to 4. I like those odds.
A clear plan for a chaotic market. Yeah. Remember, jobless claims at 8:30 a.m.
Yeah.
Watch that 6,800 gamma wall and keep an eye on those volume numbers. Don't believe the hype until you see the participation.
Stay liquid.
Stay cynical. We'll see you tomorrow.